Welcome to our first public webinar. Me and Alex Borchardt are going to present on some common questions that we get from potential investors into Parallel. Before we get into those questions, I want Alex to kind of talk about like who we are, what we do, what Parallel Lending is. We typically have these webinars for investors for every quarter. This is actually our first webinar in several years that we're doing for the public that we're putting out there. So not just for our investors here. So Alex, maybe if you want to take a minute or so and just talk about what parallel lending is, talk about what hard money lending is, what we do, and then we'll kind of go from there and talk about some common questions that I get from the investor side of things, common questions you get from the investor relations side of things, from investors over investing in parallel. But before that, let's go ahead and maybe just talk briefly about parallel lending, some hard money lending, and then we'll get these commonly asked questions we get.
Yeah, absolutely. I'm Alex. I'm one of the managing partners and co-founders at Parallel Lending. Parallel Lending is a small private credit fund, and we focus on making first mortgages to the real estate investor and builder that is predominantly for the purchasing, the renovating, and the building of single-family housing. So we provide first position mortgages on residential housing for the disposition of them and ultimately the use of income. So 12-month terms, short-term loans, that's the segment we serve, which has traditionally been served by local community banks. And after 2008, that pushed a lot of those banks out of the space.
Can we talk before we get these questions from investors? You and me both combined have probably done 50-something flips with Eric. All of us combined, Eric, our other partner, we've done so many different flips. That's how we got into the space. So we are our borrowers essentially, and used to be them. But maybe you can just briefly talk about for 30 seconds who we lend to, and what our portfolio is like with new builds, ground up construction, fix and flips homes already. Maybe just hit briefly on who we lend the money out to, and then we'll get into these questions.
Yeah, so these are business purpose loans. So they're for real estate investors and developers who are building single family residential or multifamily 1 to 4 unit. And so these are short-term business purpose loans that specifically are for contractors to leverage our funds in order so that they can make more money. So it's not for people looking to build their primary house. We sign all these loan docs that essentially make sure that this is just an investment property and something that will be used as a rental or sold in a 12-month term.
Yes, correct. Awesome. Yeah. And a common question we get obviously is how we structure our fund. That's a whole different topic that I think we can spend a whole different segment on. But real quick, before we get into other questions, we've had, I guess we've been around a year and a half for the fund purposes. Before that, we were doing a note by note lending basis a year and a half prior to that. So we've been in business crazy for about 3 years so far. And how the fund's structured is investors. It's made up primarily of investors that get a 10% preferred return. Then we split after that. Over the course of this year so far, what's our average been return-wise on a monthly basis?
Year to date, we're at 12.8. Yep. So we're well above our target. Our target's 11.5.
11.5. Yep.
And yeah, I mean, great question. We operate very similarly to a REIT. As we take income in, we distribute that collected revenue every month. So every month it changes on a monthly basis, but we do produce a dividend every month, and it fluctuates based on collections. We have a 1-year lockup. It's an evergreen fund, so there's no time horizon there.
Yeah. So yeah, just to summarize the basic broad structure of the fund, it's a year lockup. We have monthly distributions. Most investors choose to let it compound over the course of a year. We do have investors that take it out every month and it pays their mortgage or private school tuition. And that's always a great option as well. And then they have the option to pull it out after a year, or after that they can keep that. And so that's the main structure of the fund. It's a debt fund. It's a hard money lending fund, whatever you want to call it. There's a bunch of terms for it. But it's structured where LPs, who are investors, and GPs, who are us, are aligned together, where if we succeed, they succeed, and vice versa. So I think this is a really good topic to hit on at some point down the road. But let's get into these questions real quick. Something that you'll probably have a better idea on than than me. So a common question I get when talking to people who are interested in investing in this vehicle, specifically Parallel, is how many different deals or mortgages have we closed on thus far, and how many have paid out, and how many are still existing, how many have gone to foreclosure? Do you have those numbers up by chance? You can just tell us how many we've done, how many have been foreclosed, and how many have successfully exited thus far.
Yeah, so we've funded almost 80 loans. We're at 78 right now, which is total lent out about 18 million. And essentially, those have all about 47 of them have been paid off, and we have an outstanding number right now. And our range is we'll have 25 to 30 current active deals that we have under management. Essentially, we have not had any delinquencies in terms of contractual delinquencies, which is 60 days of payment that's late. We've essentially had no foreclosures or no deed in lieu of foreclosures. But historically, you want to allocate around 1% to 2% for that foreclosure rate. So if we do 100 loans, we can expect 1 or 2 to go south. And essentially, we haven't hit that road. I'm sure we will get to that point, but allocation for that for delinquent payments for foreclosures is going to be around 1 to 2%. So we budget that, and we assume that that's what is going to be our loss every year.
And we hold most of our loans on our balance sheet lenders, but we have brokered maybe 3 or 4. We have it somewhere. How many have we brokered?
Yeah.
78.
Exactly. So, we're a direct balance sheet lender. So, essentially we have, we make all the decisions, meaning that we're not jumping through hoops, going through other people's parameters when they lend us money. We have our own criteria, and we think that it's sound criteria. And I think that's a little bit why we've had no issues, and there's always, things that come up in a project, but we've had no serious issues out of the 80 loans we've done so far.
So we give, and our goal to investors is 11.5% of analyzed returns. To date, you said 12.8 or somewhere around there that we've given so far. So a common question we get is one, how are we making that? And two, why do people pay what they pay 12+%, 2 points up front, whatever it may be? Maybe you can talk about what our rates are and then why people are willing to pay that price that me and you have paid, being borrowers and flippers ourselves, but maybe give investors, people who maybe aren't in that world, an explanation of why people pay that price and maybe what our rates are as well.
Yeah, great question. So, we're able to, our preferred return is 10%. And then, there's an 80-20 split after that, GPLP. So our target return is 11.5. So we typically lend out at around 14%. We charge 12% interest and then 2 points on every loan that we fund. And that's essentially our floor at the moment. And it's a great question because real estate investors, I guess, traditionally have been served by two different groups. One is going to be the small mom and pop lenders, and their capital is kind of limited, and they don't really have sophisticated standing operating procedures. And then the other portion that served them was the local community bank, and those banks, after the 2008 Dodd-Frank laws, have been really regulated heavily. And so in order, if you're a developer and you have a property and you have to close, and that property is a good deal and it's under contract, you have to close in 7 to 14 days. If you go to your local community bank, it's almost impossible to close within a 30-day, closing, period. So typically your local community bank is going to offer you, prime +1. However, you have to have tax, your taxes has to be, 2 years of pay stubs. And it's a lot of heavy underwriting. So typically that closing, if it's a lot you own, that's free and clear and it's cookie cutter, that's no problem. You should go use that money. But for most every developer who's in this space to use money and to use our capital and make more, they need that easy access to it. And so, I would say, we have one of the things that separates us is we have an expertise in construction lending, in an expertise in real estate. So when we lend money to somebody, we are able to very rapidly evaluate risk and very rapidly make a decision. So, borrowers who use our money are, using our money only for a small period of time in order to make more. And so you think of the cost of capital, and we're not talking about 30-year mortgages where someone has to live with that interest rate for a long time. What makes this investment attractive on both sides is that we can very rapidly deploy capital to a builder who's looking to build a property and resell it. And although we get a premium for our money, we can easily allow the builder to justify it because it's easier to get, it's quicker to get. We're much more friendlier than a bank would be. You're dealing with us personally. And so we give that builder the ability to leverage our capital and scale their business. And so because of our knowledge in real estate and our background, we can help that builder out. And historically, I would say those community banks, they're heavily regulated, and there's a place for them, but they typically play defense with their borrower. And so a traditional regulated lender is playing defense on the outset, and we have the opportunity and balance the ability to essentially leverage our money and make them more money, and that's our really value add proposition. Is we go into every relationship with we don't want our borrower to use us one time. We want to have that borrower use us for 10 years consistently and turn that money over. So it really helps everybody win.
Yeah, that's great. Just to wrap that answer up, just like you mentioned, speed's the name of the game. A good deal doesn't last very long, and so they need that money in 5 to 10 days. They can't get that from a bank, and so they're willing to pay that a little bit higher. And most of the time, they're flipping hopefully 6 to 8 months of trying to get out of that. And so even though they're paying that X percentage, in the grand scheme of things, if they're out in 6 months, that 14% is now only 7%. Right. So it's just like you mentioned, the cost of doing business and the speed and the ability to get that money when needed. So let's go like 2 more quick questions. This is one that we get all the time. I'll go quickly here and then let you kind of piggyback on that. The number one question anyone gets in any industry when you're trying to raise capital, you're talking to investors, is how are you going to protect my capital? What's the downside? What's the worst that can happen? It's a question I get. I probably have 20-something meetings every week. Not every week, but 20-something meetings every month or so, just with investor-related type questions. And we always talk about what's the downside, what's the worst that can happen. The worst that can happen is, frankly, you can lose all your money. Now, that's really, really hard to do. And so how we go about that is having what we think is collateral that's worth more than the loan that we send out. So that's the number one way I think we can minimize risk and do our due diligence to make sure that the capital is somewhat stable. So that's usually my answer, is the collateral is the best way we can protect it. Alex, when you get these questions, what are you kind of answering, and how are they wording it to you when these high net worth individuals who are worth a fair amount, let's say, are looking to place their money somewhere and they want to make sure it's as safe as possible with the amount of return that they are receiving?
Yeah, it's a great question. I mean, at the end of the day, the real thing is underwriting, and the real business that we're in is understanding our collateral. And so you can underwrite a borrower's ability and willingness to repay, but at the end of the day, does that real estate asset protect your money? And so it's the due diligence on that asset, and does it protect? Taking a first lien position, is that securing enough? And we get this question a lot. And essentially, if the example I like to use is if you have a property and you value it at $500,000, and you're going to buy this property and it's worth $500,000, what we do is we ask potential investors, hey, would you put a $250,000 first lien mortgage on that property. Would you feel safe and secure knowing that property is worth 500? Would you feel safe and secure putting a $250,000 first lien position on it? And what's the worst that could happen? So as process time, 12 months goes by and the borrower runs away. Well, you now have a $500,000 asset. So in terms of risk adjusted returns, we think it's one of the best ways to make double digit returns.
Yeah. So like we said, we'll wrap this up. This is our first webinar that we've done probably in several years, not for investors. If you are an investor, then you get these webinars once every quarter. If you are interested in Parallel, me and Alex will drop our emails in the links below, the comments below. We also have a website that will drop as well, that you can set up a time to talk to either one of us about any potential parallel lending related questions here. And you can find us on, Alex, we got some social media. Alex is killing our social media game, by the way. Alex, where can they find the parallel lending social media that we put out? We put out deals that we've done. We put out deals that we've closed, exits, anything related to lending and real estate. Alex puts out. Where can we, where those handles or whatever you call it, they can find us?
Yeah. I mean, pretty much anywhere on social media, we try and just blast out on all media platforms. And you can also reach us at alex@parallellending.com, or if any of this sounds interesting to anybody, we're happy to discuss more.
Is the handles is it Parallel Lending, at Parallel Lending for
for Instagram, and then I think you just type in Google and you'd find us on LinkedIn, Facebook.
Yeah. Awesome. Yeah, Alex has killed that. We don't even know what our handle is, but it tells you how into social media we are. But we are active, so check that out. If you have a follow-up, email, let us know, comment below. And again, we're going to do these webinars on a weekly basis. We're going to be a little more specific on certain topics we have. We just wanted to introduce ourselves and give a quick background over common questions we get. And eventually, we'll be doing some live webinars as we continue this thing. Maybe we're going to put this in a podcast format. Who knows? We can figure that out. But anyways, reach out if y'all have any questions. Like the video as well. If you watch the whole thing, God, 18 minutes. Congratulations. Watch the video, like, share, subscribe. We'll see you next time.